If you have ever wondered why wealthy investors seem to grow richer every year while paying little to nothing in taxes, the answer is not magic, corruption, or loopholes meant for insiders. The answer is real estate and the tax code working exactly as it was designed. You see, governments around the world reward people who provide housing, improve communities, and take long-term financial risk. Most people never learn this because schools teach you how to earn money, not how to protect it. In the next few minutes, you are going to understand how ordinary investors legally reduce their tax bills to zero using real estate, sometimes even getting refunds while making cash flow. This is not theory. These are strategies used every year by landlords, developers, and smart investors who understand the rules better than the average taxpayer. If you care about keeping more of what you earn and building lasting wealth, this is information you cannot afford to ignore. The first thing to understand is that the tax system does not treat all income equally. Salary income is taxed the highest because it is considered active income. Real estate income, on the other hand, often falls under passive or sheltered income, which comes with powerful deductions. When you own rental property, the government allows you to subtract expenses before calculating your taxable income. These expenses include mortgage interest, repairs, property management, insurance, travel related to the property, and even legal and accounting fees. What surprises most people is that you can show a paper loss on your tax return while still making real cash every month. Depreciation is one of the most powerful wealth tools ever created, and it exists almost entirely for real estate. The government allows you to write off the value of a building over time, even though the property may actually be increasing in market value. For residential real estate, depreciation is spread over 27.5 years. Let us say you buy a rental property for $275,000 and allocate $220,000 to the building. Each year, you can deduct about $8,000 as a non-cash expense. If your rental cash flow is $8,000 for the year, depreciation alone can wipe out the entire taxable profit, meaning you pay zero income tax on that money. Now, more advanced investors, they take depreciation even further by using what's called cost segregation. This strategy breaks the building into different components, like flooring, wiring, fixtures, and appliances, so you can actually depreciate parts of the property much faster. Instead of waiting 27.5 years, you might, write off a large portion within the first 5 years. A real-world example would be an investor buying a small apartment building and, by using cost segregation, creating a $100,000 paper loss in the very first year. That loss can offset income from other rentals, or even certain types of earned income if everything is structured correctly, which can dramatically reduce or even eliminate your taxes. For investors who treat real estate as a serious business, the tax code, it offers an even bigger advantage known as real estate professional status. If you or your spouse spend enough time actively managing properties, you may be able to deduct real estate losses against ordinary income, like a salary or business profits. This means those rental losses can actually reduce taxes on income earned outside of real estate. You know, many households use this strategy to legally bring their tax bill to zero while building a growing portfolio. The key, really, is proper documentation, tracking your hours, and working closely with a knowledgeable tax professional. One of the biggest fears investors have is, paying massive taxes when selling property. A 1031 exchange solves this problem by allowing you to sell one investment property and reinvest the profits into another, without paying capital gains taxes at the time of sale. This lets your money keep compounding rather than being handed over to the government. Investors often use this strategy to start with small properties and gradually trade up into larger, higher income assets over time. By repeating this process, it's actually possible to defer taxes for decades. So, rental income is taxable, but, loan proceeds are not. When property values rise, investors often choose to refinance instead of selling. This way, they can pull out cash while still keeping the asset. And here's the thing. The money received from a refinance isn't considered income, so it's actually tax-free. An investor might buy a property, let tenants pay down the mortgage, then refinance after the property appreciates and use that cash to buy another property. This cycle, it builds wealth without triggering any taxable events. So, here's the thing. The real power comes from combining depreciation, cost segregation, refinancing, and smart exchanges into, one long-term strategy. An investor can earn rental income, shelter it with depreciation, reinvest tax-free refinance proceeds, and defer gains through exchanges. On paper, taxable income stays low or even negative, while net worth and cash flow, just keep growing. This is how so many investors legally pay little to nothing in taxes for years, all while expanding their portfolios. But none of these strategies work if they're done carelessly. Entity structure, record keeping and compliance, these are absolutely essential. The goal isn't to avoid taxes illegally, but to follow the rules precisely. Investors who succeed for the long term treat taxes as part of their investment strategy, not just an afterthought. A good accountant and a clear plan, they really do make all the difference. Real estate, you see, is not just about owning property. It's about understanding how money, taxes, and incentives really work. When you master this, you stop playing defense with your income and start building offense with your wealth. If you found this breakdown valuable and want deeper, practical lessons like this, make sure you subscribe to the channel and share this video with someone who's serious about investing. This knowledge changes lives when it's applied. And honestly, the next smart investor could be you.